Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist, First Trust Portfolios. We are in Wheaton, Illinois, and remember, we want to be the antidote to conventional wisdom. Well, the conventional wisdom right now is that this correction in the stock market is the real deal. It's because of Greece, it's because of China tightening its monetary policy, it's because the second leg of the the double dip is here. Nouriel Roubini is back on TV, convinced that the market is heading back down, and I love this. I'm happy about this because we needed a correction in the marketplace. But all of this correction, all of this fear, all it's doing is presenting us another opportunity to get in. We are not going back to the lows in the Dow. If you look at earnings at the S&P 500, they're still well over 70% beating their estimates. The economy is on a roll. Many people thought that the only reason retail sales were going up was because cash for clunkers, because of government stimulus. Well, the stimulus has run out. The cash for clunkers is dead. It ended in August. If you look at September to January, retail sales are up 10.9% at an annualized rate. If that's a new normal, I want more of it. One of the reasons that retail sales are up is because the job market has begun to improve. The unemployment rate has fallen from 10.1 down to 9.7%. The civilian household employment report, that's the one that tends to lead the payroll employment report in recoveries. It's up 110,000 jobs per month on average in the last 3 months. That's great news. But even more importantly than that, manufacturing jobs went up 11,000 in January, first time in 3 years for that. And the hours worked in the U.S. have expanded by about 4% at an annualized rate in the last 3 months. Now, if you take those hours of work and you say, let's say we didn't increase the work week, how many employees would we have had to add at the work week that existed 3 months ago to have that kind of increase in hours? It would have been 200,000 jobs per month. In other words, the equivalent production increases we've seen in the U.S. have been the equivalent of 200,000 new jobs. That means earnings have picked up, pay has picked up, and we are now entering a self-sustaining V-shaped recovery. We continue to believe that GDP will grow 4.5% as we move through 2010. It may grow faster. The 5.7% real GDP growth number in the fourth quarter was way stronger than the consensus expected, and even stronger than our 4.5% forecast. And what's interesting about this is lots of people say, oh, it was only inventories. If you take out inventories, we only grew 2.2%. Well, what they don't say is that inventories actually declined in the fourth quarter. They fell by $33 billion. $33 billion less in inventory at the end of the quarter than we had in the beginning on October 1st. And you say, well, then how did they add to GDP? Well, the reason is they declined by less than they did in the third quarter. Inventories fell $139 billion in the third quarter. And so that $100 billion difference, it was a $100 billion less negative in the fourth quarter, which added to GDP growth. That's the way the GDP math works. So the bottom line is that inventories are still declining. In other words, retail sales were faster. They went up by more than manufacturing did in the fourth quarter. That means that manufacturers are going to have to catch up. The inventory building has not yet even begun, and we believe that it will be very easy for GDP to get to about a 4 to 4.5% average during 2010. The correction that we're experiencing right now is just making the market even more undervalued. We did our Dow 13,000 video, Econ Wesbury 101, last week, and we still obviously believe that. But now the gains will be even larger from these new lows to that new high. This is a correction. It is not a change in direction. It's not a double dip. Finally, let me just deal with Greece. Greece is a relatively small country. Banks in America have almost no to very little exposure to Greece. This is nothing like the Latin American crisis of the early 1980s. Remember, the 8 biggest banks in America had 260% of their capital lent to Latin America. And if that didn't take the U.S. economy down, Greece isn't going to take the U.S. economy down. This is not the beginning of a new subprime crisis. Banks had lots of exposure to subprime loans. They have very little exposure to Greece. Finally, China tightening is great news. China should be tightening. China has our monetary policy. They link to the dollar. We should be tightening in the United States. And that tightening, just like it was true in the 1980s, will be a good thing for the United States, not a bad thing. It will signal that growth is back, that inflationary pressures are rising, and higher interest rates, in my opinion, will not shut down growth. We can grow through with much higher interest rates than we have today. In fact, if we don't start to tighten, we're going to have more of an inflation problem in the years to come. So to put all this in perspective, the worries are still there. We suffer from an economic Stockholm syndrome in America. So the minute the market goes down by 5 or 6%, Nouriel Roubini is back on CNBC touting his negative outlook. But guess what? You don't have to worry about it, because the V-shaped recovery, the end of the panic, is occurring right now, and it's not as bad as you think. Once again, we want to be the antidote to conventional wisdom. Good luck and good trading. See you next time.